Good morning and welcome back to class. My name is Jonah Beecroft. In this tutorial, we are diving into the fascinating world of control accounts. Your best business friend for tracking those who owe you money and those you owe money. Whether you are a student, a beginner in accounting, or just need a quick refresher, this video breaks it down with simple explanation, exposing the examiner trick with simple examples. What are you waiting for? Grab your calculator. Let's bring those numbers into life. What is control account? Control account is a summary account in the general ledger that shows the total balance of a group of related accounts in a subsidiary ledger. I take it once more. Control account is a summary account in the general ledger that shows the total balances of a group of related accounts in a subsidiary ledger. Control account is generally split into two: the sales ledger control account and the purchases ledger control account. The sales ledger control account is also called the debtor ledger control account, while the purchases ledger control account is also called the creditor ledger control account. The debtor ledger control account has another name. It is also called the receivable ledger control account, while the purchases ledger control account is also known as the payable ledger control account. That is to say, the sales ledger control account can be called debtor ledger control account or the receivable ledger control account, and the purchases ledger control account can be called the purchases ledger control account, the creditor ledger control account, and the payable ledger control account. Now, we are going to dwell much in this tutorial on the sales ledger control account. The sales ledger control account is a current asset account, while the purchases ledger control account is a current liability account. As a current liability account, the sales ledger control account increases at the debit side and reduces at the credit side. We are going to be taking a look at all items that will cause increase or that will be recorded at the debit side, and all items that will cause decrease or that will be recorded at the debit side of the sales ledger control accounts. Now, the sales ledger control account takes care of only credit sales. Only credit sales. So all credit sales in a business is recorded in the sales ledger control accounts. That is why we have the debit here. We put plus. That is the area that it increases, or the side it increases, and we put minus in the side that it decreases. So that we are going to take a look about of all the sales on credit and the payment made, all the sales that are made on credit on the period, and all the payment that is made in the period. That is all what sales ledger control account is all about. Now, the sales ledger control account is specifically for only sales on credits. Only credit sales. It is a debtor account. Debtors are current assets. Everything that will increase this account will be recorded on the debit side, and everything that will reduce it will be recorded on the credit side. Now, we are going to take a look at the sources of information to compile the sales ledger control accounts. Or another question I put the question in another form. Where do we get the information that we use to complete the sales ledger control accounts? There are about 4 sources. We have the sales day book, or the sales day journal, or the sales return day book, or the sales return journal, or the cash day book, or the cash journal, or the general journal. These day books, this book of original entry, give us specific information about the sales ledger control accounts. For instance, the sales day book is the book or the prime entry, the book of original entry where all credit sales are recorded. The information we'll be getting from the sales date book is the total credit sales, only credit sales. Then the sales return journal, we are going to be getting information of the sales return, that is return inward, and it is only return based on credit sales. Only return based on credit sales that we will be getting from the sales day, the return journal. That is to say, we are going to get only return on credit sales. Then the next book, or the cash book, we are going to get information about those debtors that have paid some money to reduce their debts. We are going to get information about those debtors or a credit customer whom we have refunded some money to as a result of overpayments or as a result of sales return. We're also going to get information about the check dishonor or dishonor check from them, from the cash book. We also get information about the discount allowed to credit customer. These are the information we will get from the cash book. Then another information we'll get from the cash book is dishonor check that have been issued and now dishonor. We are going to get all this information from the cash book. Then the general journal is a journal that will enter transaction that cannot be entered in other specialized journal, another 3 specialized journal. For instance, interest charge on customer overdue account is gotten from the general journal. Contra or set of transaction, we can get that information from the general journal. And also bad debt written off is information that we can also find from the general journal. And be receivable dishonor can also be gotten from the general journal or the journal proper. Now, all these items mentioned are items that are to be recorded in the sales ledger control account. For instance, credit sales, return inwards, cash received, cash paid, refund, a dishonor check. All these are items that are items for sales ledger control accounts. The format of sales ledger control accounts. The format is like the key, it's the master's key to get every knowledge that we need in control accounts. Everything that we are going to do in control account is going to follow this format. The control account, being a current asset account, increases by the debit side and reduces by the debit side. So all credit sales balances brought down from previous periods are to be recorded on the debit side, while all payments made, everything that reduces the total debt, will be recorded by the credit side. Now, the first thing that we bring into for in this format is the balance brought down, if any. If there's any balance brought down from previous period, it will be brought here by the debit side, because asset account take their opening balances by the debit side. So balance brought down by the debit side. And you can also find that there's also a balance brought down at the credit side of this account. This balance brought down at the credit side is as a result of overpayment by credit customer. Some of the customers that are owing us have made payments and made an additional payment or made an overpayment, and such an overpayment is a liability. It's a current liability, and so should we be at the reducing side of at the sales ledger control account, which is what the credit side. Another thing that will increase this account that will be on the credit side is credit sales. That is the balance of the sales journal or the sales day book will increase it, and so it will be by what the debit side, that it shows the total amount of sales on credit in the periods. Another thing again that will increase it is interest on customer overdue accounts. Customer that bought on credit that did not meet up and the payment terms of the stipulated period may be charged interest, and that interest will increase the total debt. Another thing is bill receivable dishonor. Bill receivable dishonor is likened to be check dishonored. Then the next thing that will reduce it is discount allow. When the credit customer are allowed discount, that will reduce the total amount they will pay. Then bad debt written off is also will be at the reducing side, because it reduces the total amount of debtor or receivable. If you did not call it debtor, you call it receivable or debtors. Now, the bill receivable is like cash received, is also a reduction in the total amount of debts. Check from customer, that is the money paid through the bank through check, also reduces the total debt. When we get cash payment also, cash payment reduces, the amount the debtors are owing the business. So it will be on the credit side. When there is also when there is return inward or sales return is also to be recorded at the credit side, because sales return or return inward reduces the total debtor or total receivable. Now, another thing that will reduce it is purchases ledger contra. Purchases ledger contra will reduce the total debtor. Then after taking all the item that reduces to the debit side, to the credit side, now we now take the balances of the debit side and the credit side, recognizing the lower side and also paying attention to the difference. We will insert the difference to the lower side and call it balance carried down. And that balance carried down will be the actual total receivable, which will be taken to the debit side of the SalesLedger control account, because balance brought down of all assets are recorded by the debit side. So the balance brought down is to be shown by the debit side. And there's also a balance brought down that is shown in golden color by the credit side. That balance by the debit side, by the credit side, is showing the overpayment that is due to be refunded back to customer, which had not been refunded as at this period. So it is a liability that is supposed to be refunded to the credit customer for overpayments. When this overpayment have been refunded, then this balance brought down will no longer be shown at the credit side of these accounts. Now, let us expose the examiner's trick. The following items are items that the examiner will use to test you whether you actually know what you are doing in this section or in SalesLedger control account. All these items that are enumerated below are to be ignored when you are compiling the SalesLedger control account. The first item there is cash sales. SalesLedger control account is specially designed for sales on credit and has nothing to do, I repeat, has nothing to do with cash sales. Cash sales are recorded in the cash book. Examiner will bring in items of cash sales into the question to check or to try you, to trick you whether you know what you are doing. Cash sales are not items for SalesLedger control accounts. Cash sales are items for cash book and are recorded in the cash book. All allowances should be ignored in the SalesLedger control account. They are not to be recorded, including all provisions. All provisions, all allowances are not to be taken into cognizance. Trade discounts. The trade discount are discounts are quantity discounts to encourage the customers to buy in large quantity. They are not to be taken into cognizance in SalesLedger control accounts. Discount, that is number 5. Discount allowed on cash sales are not also to be taken into cognizance. It is only discount allowed on credit sales that should be taken into cognizance. Bill receivable discounted should also be ignored. Bill receivable discounted is a financial cost. Now, in any question, when there is bill receivable and bill receivable accepted, choose or pick the bill receivable accepted and leave the bill receivable. But where there is only bill receivable, assume that bill receivable to be the bill receivable accepted. When in a question there is bill receivable and there is bill receivable accepted, just ignore the bill receivable and accept. take the bill receivable accepted. And where there is only bill receivable, then just assume it is bill receivable what accepted and take it into what cognizance. Now let us go into practice. Practice number 1. It says, prepare a sales ledger control account from the following: sales ledger balance 6,708, total for March, a discount allow 300, cash from debtor 8930, sales journal 11,500, bad debt written off 115, then return inward is 210. Now it's an asset account, debit and credit. Everything that will increase it will be by the debit side. Anything that will reduce it will be by what? The credit side. Now the first thing that will bring by the debit side is the balance brought down, which is balance brought down 6,708 will come to the debit side. Then balance brought down 6,708 will come toward the debit side. That is the balance of receivable brought down from last month to this month. Debtors are still owing up this amount, now brought down to this month. Now another one thing that will reduce it is this discount allow. When you allow customer discount, it reduces what they have to pay. Cash received from debtor. The cash we receive from debtor has to reduce the total amount they are owing us. For this account, it's a total debtor account. So anything that reduces the total debtor amount will be recorded in the debt and in the credit side. Now, when you have sales journal, it means the balances in the sales journal or the sales day book, that is the total credit sales in the period. Then the next thing is return inward, the sales return. When customer return value they have paid for, that will reduce the amount they have to pay. Or if a return value on sales on credits, that will reduce whatever they are going to pay when the time is due. Now you take the total, the sum of the debit and credit side, recognizing the differences and inserting the difference in the lower side to enable it to balance. And you bring that difference, which is balance carried down at the credit side, to the debit side as balance brought down. That is, balance carried down now will be 8,653. This balance carried down is on the debit side because it is an asset account, and all asset accounts take that closing entry balance by the debit side. So the total amount of debtor at the end of this period is 8,653. Now, this example 2 or practice 2 given below is a sales ledger control extract. Balance brought down is 12,750. Credit sales is 28,180. Cash from debtor is 12,112. Discount allow is 638, and sales return is 1,500. You are required to prepare sales ledger control accounts. The same way we did the other one, at the debit side and the credit side. The first thing you will bring here is the balance brought down, being total of debtor for last month brought forward to this month is going to be in the debit side, because asset account take their opening balance brought down balance by what? The debit side. Now balance brought down 12,750. Then discount allow, reduce it, or cash from debtor, when debtor pay part of the cash they are owing, that will reduce what they are owing. Cash from debtor is 12,112. Then a discount allowed from equation is also one of the items that reduces it, and it is worth 638. Then the next thing we are going to take a look at is we have not taken credit sales. Credit sales is 28,185. 28,185. The last thing in the question is going to be return, sales return, which is 1,500, and that is all. Then we take the total balance, we sum the two sides, the debit side and the credit side as usual, recognizing the difference and inserting the difference in the lower side. The difference now is 28,685. And the total is 40,935. Then we balance off. By putting a double strip. We balance off. Then we bring out our balance carried down to the debit side of the account, because it is the actual balance of debtor at the end of this period. So the balance brought down is on the debit side because it's an asset account, and all asset accounts take their closing balances brought down by the debit side. Then the next question is question 3. It says, below is the SalesLedger control account extract from Don Zion Enterprises. From Don Zion Enterprises. Opening balance is 24,590. That is the opening balance. Then credit sales or sales journal balance is 18,700. Cash from debtors or customer is 14,250. Cash from debtor or from customer, credit customer, is 14,250. That is the amount that I've already paid by customer. Return inward is 1,000. Sales return or return inward is 1,000. Bad debt written off is 400. Bad debt written off is 400. Refund for overpayments is 150. this is overpayment. Our creditor paid us more money than is owing the business, and so it's an overpayment, and so should be reformed to him. Then contra, which is set off between the sales ledger control account and the purchases ledger control account. It says you are required to prepare a sales ledger control account. You are required to prepare a sales ledger control account. Use this question to test yourself. Use this question to test yourself whether you are flowing with us. To know accounting is to do accounting. To know accounting is to practice accounting, and make sure you use it to test yourself so that you will know whether you are flowing with us. The next question or the next example is exercise 4. So use this extract from the sales ledger control account below to answer this question. Balance brought down on the 1st of June 2024 is 42,300 on the debit side. On the debit side. Another balance brought down on that 1st of June is 1,200 on the credit side. Transaction during the month of June. You know, these balances are from 1st of June. After taking these balances in the beginning of June, then this transaction takes place in the month of June, or this transaction took place in the month of June 2024. Now, the first transaction there is credit sale. This credit sale is 25,800, which is the sales journal balance in the month of June 2024. At the end of month of June 2024. Then cash from customers in that same month is 30,100. Discount allowed to debtor or to credit customer is 600. Now we have, what is that? Sales return. Sales return or return inward is 1,000. You have bad debt written off, which is 500. Bad debt written off is different from bad debt allowances for bad debt, and is different from provision for bad debt. Provision for bad debt are not taken into cognizance here. Dishonored check. Dishonored check is 400. Check have been previously issued and now are dishonored for certain reasons. Then contra. Contra is a set off between the sales ledger control account and the purchases ledger control account is 700. You have closing balance of debtor. The closing balance of debtor is given. The closing balance of debtor is 35,600 on the debit side. That is the actual total debtor or total receivable. Actual total debtor or actual total receivable. They say you should calculate the credit balance of balance brought down. That is the credit side of balance brought down. That credit side is or should be an overpayment made by customer in cost of paying their money or paying their debt, and that amount is a liability and should also be what refunded back to what the credit customer who made such overpayments. Now, solution: the SalesLedger control accounts, the debit side and the credit side, the reducing side and the increasing side. Account is recorded in monetary form, so the unit of account must first of all be stipulated, that is in naira. Then the balance, debit balance brought down 42,300. This is debtors brought down from last month. Then the credit balance brought down is overpayment, a liability that we have to refund back to what? The customer. Is it clear? The balance brought down by the credit side, which is the one in the blue color, is a current liability. It is amount to be refunded back to a customer that have made overpayment to the business. This can arise as a result of additional payments for additional supply or as a result of return inward that have not been settled. It can also arise as a result of an error. Now, the next thing that will be in the debit side is the total journal balance, which is the sales on credit, which is worth 25,800. Then the cash received from customer, that is payment made by debtor, will reduce it, and that is worth 3,100. Discount allow to customer will reduce what the total debt, and it is worth 600. Now you have sales return inward is 1,000. Bad debt rating of is 500. Then dishonored check. Dishonored check should increase it with 400. Dishonored check, a check issued before but now dishonored. Contra is always on the reducing side of both the SalesLedger control account and the purchases ledger control account. It's a set-off between the SalesLedger control account and the purchases ledger control account. Then the closing balance as given in the question is 35,600. This closing balance is given in the question. It's a debit balance. So it will be taken toward the credit side as balance brought down or closing balance. And by the time you compute the sum, the debit balance at the debit side and the credit side, you will discover a difference, and that difference should be the amount that will be refunded to the customer, which is what the overpayment. It is the one that is written in blue, in light blue color as balance carried down. Okay, that should be balance carried down. It's supposed to be balance carried down by the debit side. Let us try to correct it. If it is correctable, let us see. That one's supposed to be balance carried down. Balance carried down. Balance carried down. Supposed to be balance carried down. Okay? It is supposed to be balance carried down and not balance brought down. Supposed to be balance carried down. Let us correct it. Supposed to be balance carried down. Balance carried. Balance carried down. Balance carried down. Yeah, that's how it's supposed to be. Okay, then insert. Yes, it has been corrected. It's now balance carried down. Now, do not make a mistake. The balance brought down at the debit side is the actual debtor, while the balance brought down at the credit side is a refund. On this note, we come to the end of this tutorial. We thank you for taking time to learn with us. We also thank you for liking our channel. We thank you for subscribing to our channel, and we thank you for sharing our channel. Our next tutorial will be Control Account Part 2. We are going to explore the purchases ledger control accounts. Until then, take care of yourself. God bless you. Bye.